Good Monday morning, Market Chameleons, or Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dmitry Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. And there's the disclaimer.
Perfect.
I'm going to share my screen. And as I'm doing that, quick note, anybody join us for the first time, Will and I, we do this show in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, you could type it into the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. Click on that link. Once you get over to Zoom, there's a button, raise your hand. Click on that. That will notify us you have a question. Once we let you in, you could ask your question live and direct. While to give you guys a chance to type in your questions and for more people to join us, we're going to take a couple minutes, take a look at the pre-market report, see if we could get insights on what's going on in pre-market hours, and then we'll move on to the questions. So pre-market report, these are stocks trading in the pre-market hours. I'm going to come down here and I see we have a list. We have a list of our most active stocks, biggest percentage gainers, biggest percentage decliners. Here we have 36 stocks that made our percentage gainers list, 94 on the decliners. So from this perspective, right now, it looks like we're setting up for a bearish bias at the open. Let's look at it from another perspective. Up here, we have this calendar view. This is showing us by individual dates. You could go back days, what happened in the pre-market hours from a high level. It's a summary. So October 3rd, that's today. So far, we have 210 stocks trading higher in the pre-market hours, 446 stocks trading lower. If we look at the volume, we got 116 million shares trading on up volume versus 67.4 million on down volume. But if we convert those shares to dollar value, not every stock same price, we got 668 million shares trading on up volume versus $2.4 billion on down volume. So from that perspective, also looks like so far we're setting up with a bearish bias at the open. If I come down here, I'm going to look at it from one more angle and then we'll go to questions. If I come down here below, we see that on this list, we have small cap stocks, there are ETFs in there, preferred stocks, leverage products. So pretty much any security listed on a major US exchange, if it's trading in pre-market hours, it can make this list. And to narrow down to a smaller group of stocks, we could use the filters above. If you have a watch list, you could filter by your watch list. I'm going to use this one, an ETF. As an example, we're going to drop it down. We get a list of different ETFs to choose from. Some of them are sector ETFs. Up here, broad-based ETFs. Let's click on SPY. That's S&P 500 ETF. When we do that, the list below gets filtered by stocks that are holdings in the SPY, which are the S&P 500 constituents. And here we see one stock made our percentage gainers list and 14 on our decliners list. Of course, these are this list does have conditions that it has to meet that we preset with volume, price move, liquidity, and so forth. So far, every indication is really that the trading in the pre-market hours has some bearish sentiment. So I guess we gave it a couple minutes. Well, if we have a question, I'll take it.
Well, if there's people are still talking about the box spread yesterday.
Okay.
Jackie was saying still confused on the box spread strategy. Only make interest money from the credit received on the front So he's still wondering if there is even an opportunity. I mean, mostly box spread should be priced right around the distance between the strike prices, right? If it's trading out of line, it may, and when you were trying to get this across yesterday, it may mean something is wrong in the market, and you have to be careful when you trade it for sure.
Right. So the idea behind it, we'll come back to the box spread over here. So the idea behind the box spread is that when you set it up, you're setting it up on two different strikes. So let's say the distance between the strike prices are $5 or $2 or $3, and in theory, the box spread at expiration will be worth the difference between those strikes, with the assumption that none of your option legs gets exercised or signed before expiration. Okay. And then there's some pin risk. So there is that risk of early exercise because we're dealing with American style options. So we'll set this up again. We could use different strikes than yesterday. Don't remember, what we did, but let's just say, we do the 420 strike, right? So the 420 strike, let's just start out by selling the 420 call, buying the 425 call. So what do we have here is a call spread, right? This is what a call spread would look like. All right, so we got a credit of $3.72 on a $5 call spread. But at the same time, right, and what is the call spread as you could see here, has a bearish bias, right? You have a delta, negative delta, that benefits if the stock goes down, right? If the stock goes up, you lose. If the stock goes down, you win. So this is the payout diagram of a call spread. So to complete the box spread, now we're going to do a put spread on the same strikes, but one with a bullish bias, right? Going the other way. So let's do that. We sell the 425 put, right? And we buy the 420 put. So this is a credit put spread. So now we got another credit coming in. So you could see here, this is what I did. I first sold the call spread, 420, 425, right? Bearish, which is a bearish bias. Then I sold the put spread, the 425 put, buying the 420, same strikes. It's a bullish bias, right? They offset each other. And this spread, in theory, if none of these legs gets broken up, right? None of these legs gets broken up at expiration, will be worth $5, right? So let's just run that. Right, so if you're selling it for $4.95, you could see that at expiration, right, you would lose $5 because it would be worth it would be worth $5. Sorry, so you'd lose 5 cents, right? So you sold it for $4.95, you bought it back for $5, you lose 5 cents. 5 cents times 100, because each contract is 100 shares, you're losing $5. So that's what the box spread is in theory. It's actually not considered a risk for that reason. For this reason, it's not considered, a very, risky strategy if you know how to manage it, right? So if you understand the risks and how to manage risks, then it's not considered that of a risky strategy. But the risk comes from the early assignment. So why would you even do it at this state? Why would you sell something for $4.95 and buy it back for $5, right? Even would that make sense Well, if you sell something for $4.95, right? You sell something for $4.95. Well, that means that you get a credit in your account, right? When you sell something, you get a credit in your account. And when you get a credit in your account, that cash should be earning you some interest, right? So you should be, in theory, you should be earning the risk-free rate. That's how options are priced. You're earning the risk-free rate, right? That you could go and buy the short-term treasury or whatever. So in theory, if you're earning the risk-free rate, if you are, it's like borrowing money, right? You're borrowing money $4.95 with the promise of paying it back at $5, right? Just like if you went to the bank and borrowed money, well, at the end of the day, at the end of 2 months, 3 months, you have to pay them more than you borrowed, right? But if you borrow money from the bank and you could yield more interest on it somewhere else, and then you pay back the bank and you keep the difference, then it could be a profit, right? So like a lot of that carry trade is happening in real estate, right? If you go to the bank and you borrow at 3% interest and you get a mortgage, and then you rent out your property and your rent covers the mortgage payment that you pay back to the bank, and there's something left over, then you're making that extra yield, right? So even at $4.95, sometimes it may be even there a good sale, and for some people, $4.95, buying it for $4.95 to make the extra 5 cents is worth it, because that's what is bid, right? So you got whatever 4 calendar days. So in 4 calendar days, a market maker is willing to pay you $4.95 because that extra 5 cents makes sense to him, because he could borrow money and purchase this for $4.95, and whatever it costs him to borrow will be less than what he's going to get at the end, $5. Maybe it costs him 3 cents or 1 cent, so he stands to lose 4 cents, right? It stands to make like 4 cents or 3 cents, whatever it is. So it's the difference between the interest rate that you could borrow and lend, right? Like a bank, right? The differences between the bar, but then there's extra risk. Like even a bank has risk. They lend money, to get a mortgage, but there's always risk that you don't pay back, you default, the property is dilapidated, they take over the property, they don't get their money back. So there's risk, right? There's still risk in here. The risk in the box spread is that one of the legs gets broken up, right? So for one of the legs to get broken up, you have 2 short legs, right? So you're in control of the long ones, but you have two that are short, right? You have a call that is short that somebody could exercise and you get assigned, and you have a put that you're short that somebody could exercise. How likely is it that they're going to exercise? Well, it depends on the circumstances, right? So why would somebody exercise this put? Well, if the put is deep in the money, if it becomes a 1 delta, there's no time premium, then the holder of the put, may find it economically beneficial to exercise the put and convert the put to short stock for the same reason, because it's an interest rate thing. If you exercise your put and you convert it to short stock, well, then what happens when you're short stock? You receive a credit for that amount that you shorted, right? You sold something. That means now there's cash in your trading account. Well, that cash can start earning you interest, right? If you hold a put, you're not earning interest because you actually, you're net debit, right? You bought something, but when you're short something, you're net credit. You sold something, you got money in. So when you exercise the put, all of a sudden now you got this credit in your account. You have a positive cash balance, and cash can earn interest, right? So that's why you are at risk of assignment, right? You're at risk that this box spread will get broken up prior to expiration, right? Your bet is that it won't if you're short, but what if you're long it, right? If you're long it, now you have the option to exercise, the deeper in the money. So that's your benefit, that you might be, you might have the view that, hey, you know what, maybe this stock will drop way below this, and then I'm going to exercise the put and convert it and earn interest. So there's risk to the strategy. You have to understand the risk, know it, and it has to be acceptable to you, and you have to know how to manage it. So I think that the idea, behind it is not just to look at it and say, oh, this just looks juicy, I'm going to do it. It's to understand the risks, and am I here at a bigger risk, or is this risk acceptable? Because when you think about it, I think somebody mentioned yesterday that they're not allowed to execute this box spread, right? Like, I think, did somebody mention that?
Yeah, it was a Fidelity account.
Okay. So whatever, yeah, it might not be, you might not be approved in many different places for box spread. But when you look at this strategy, right, just take a look what I did. You're allowed to, if you're allowed to do a call spread, and if you're allowed to do a put spread, well, that's what I did. I did a call spread and a put spread, right? So you're allowed to do that. But why they're probably blocking you from a box spread is, with the box spread, you have a certain intent, right? You have a certain intent, and it could look good on paper, but you need to really understand, when the contra party may exercise the other side, right? That's where you get trapped, when you don't fully understand that, right? So when you're trading options, like, think of it, whenever we price options and we trade options, the assumption is always that you already understand them, you know how to trade them efficiently, right? Because there's no way to price things thinking that people are going to do all these inefficient things. It's always like you're going to do the rational thing. You're going to trade it efficiently, and that's how things are priced. So when you see mispricing, right, you could see something that we could find a box spread right now that's bid over $5. Here, I'll show you. Probably this one. Where's the stock? 427. So let's try this one. 430. Wait, where did I go here? Sorry, guys. All right, 430, right? I'm going to do the same thing. 430, and I'm going to buy the 435 call. So you see I did an out of the money call spread. And then I'm going to do the put spread. 802. Well, this one's wide. This one looks wide to me, but let's see what happens. And this might be too wide, but let's see. So, okay, so 501 bid. So there you go. So you could sell this one over $5, right? And at expiration, you could see this looks like it'll be profitable no matter where the stock is. But this is assuming that none of these options got exercised early. However, why is this bid over $5? It's because the put, you're deep in the money. You see this put that you're short 435. Well, it's already almost $10 in the money, right? Where's the stock? 427. Okay, so this is already, almost $8 in the money. So the more the stock goes down, the closer this put will get to a 1 delta, right? And once it's a 1 delta, that means that there's probably no more time premium. You can't sell it. You can't sell it above parity. So it becomes an early exercise candidate. And if you exercise it, right, your short stock, you start earning interest. And that's why this maybe looks good on paper, right? This looks good on paper because of, oh wow, look at my payout diagram. At expiration, this makes money everywhere. But this is assuming that none of this got exercised, or right, because we don't know for sure if somebody's going to exercise or not. It's assuming like if this strategy looks like this at expiration, right? All these legs. But if the stock goes down, most likely you will get a sign. Probably, very high probability you will get assigned on this put if the stock keeps going down and this goes to 1 delta. So that's the risks of this strategy. If it goes up, then you probably will be good, right? Then you'll be good because then your risk is the assignment on the call. But the reason to exercise the call in this situation would be if there's a dividend, but there's no dividend, right? So it's not likely they will you will get assigned on the call, because there needs to be a reason. There needs to be a reason why he would want to own the stock instead of the call, right? But if he exercises the call, then what he does is just converts the call to stock, which has even a higher carrying cost, right? So then he owns the stock, so it has a higher carrying cost. But you would do that if you're receiving a dividend or some kind of corporate action, that you need to own the stock. So these are the two, and then you got pin risk, right? And then you have a pin risk if the stock closes at exactly the strike price, or near that strike price, when you're not sure if the short side of your leg will get assigned or not. So those are, those are 3 risks, right? So you have 3 risks there. You have the risk getting assigned in a put, assigned on the call, or that there's pin risk, right? And you got to look at those probabilities. What's the probability we close exactly 430, exactly 435, and in this situation, or the probability that the stock continues to go lower or is down here. If the stock goes higher, you should be good. If it goes lower, this will get broken up.
Very cool, D.
Yeah.
Nothing else popped up about the box spread after that.
Okay. Yeah. And look, there could be really useful at some times, depending on your outlook. You just have to know the risks, right?
Actually, Jackie did say something. Sorry, Jackie, I missed it. It says, so it is critical to find box. He's referring to pairs. But it's a box spread with edges, credits greater than spreads. Can MC tools help us do this? Is the question.
See, again, I think you're looking at it as if I just find it as a credit than to do it. That's why they're blocking you, right? Because you're not asking that they're blocking you because you can't just simply.
That's not him being blocked, but you're just using that in generalization,
right? Right. It's first to understand. Okay, yes, you will find something for credit, but it's probably for a reason, right? This one is for a reason because what's happening now is it's getting closer, right? It's in the money. It's getting closer to where if the stock continues to stay here or go lower, this will become an early exercise, right? So you still have to have an outlook. I would say in general, if I had to choose a side, I would rather buy a box spread that's undervalued than sell one overvalued. Because then I'm more in control. I'm more in control of exercising one of those legs. So, I would probably not in every circumstances, but if I was trying to scan and look for, an opportunity for box spread, to be more in control, I would look for to buy one at a discount than to sell one at a premium because you're at this mercy more, you're at more mercy to the other side, right? Then you have control. So you won't, but those opportunities, like, think of it this, these are things that the machines at this point would capitalize pretty quickly. It's not likely that you just have something like sitting there like this. It would almost have to be like traded into it, by doing different legs. But it's not likely that you're just going to sit there and find something like at that of a deep discount, because again, this is not managed right. It's not considered a risky thing, if you know what you're doing. If I wouldn't say this is a good do either at 501, right? Because I could see right here, I could see that it's already in the money. This put is in the money. This put in a, how much time do we have left here? This put could get, let's say you get assigned in 2 days, right? So if you get assigned in 2 days, that means that you have 2 days of interest, right? That you're going to be at 435, right? So you think you're going to make a penny. You sold it for 501, you're going to make a penny. But if you pay 2 days of interest on 435, that's 13 cents. So your penny profit turns into a 13-cent loss, so 12-cent loss, right? You lose 13 cents, you got a penny, you lost 12 cents. So it's a loser at that point, because then you have to carry that position because you're long stock. Hopefully that kind of makes sense there. But we're
There
right
you
up near the end. Yeah, we're right up near the end, and really, look, I'm showing the box spread really to try to start explaining the risks more than.
Yeah, no, you're using it for education. I mean, you're trying to educate.
Yeah, I'm not telling you guys to go do
right?
it. Yeah,
This is strictly if you research box spread, all you got to do is a Google search. It's not a heavily used trade, but from an educational standpoint, it's trying to teach you the risks, right? And if it's trading out of line, chances are, if there isn't something wrong, it will be traded back into line by the systems, right?
Yeah, but
if it's trading out of line, it's because they're looking for people to step in and take the other side, because there's risk to typically being, things getting called away. So you got to be careful.
Right. So I'm showing you just to understand the dynamics of trading and the risks involved.
We did have a question that, as I go to over to the Zoom, from Allison, we could maybe look at it tomorrow. Can you please go into detail about the block trades tab? Allison, there are a lot of videos out there, but maybe we'll hit it again tomorrow. Okay. Awesome job, D.
All right, everyone. Thank you for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, chameleons. We'll see everyone tomorrow.